I was in Seoul recently, and the Koreans definitely see that. And the Koreans are taking a very conservative view. They have their own issues domestically, as you appreciate at the moment. They've also got the IFRS 4 coming into play, which is a Solvency II related accounting. So it means that they're being very careful and restrictive.
And that's why they're buying Commerzbank. That's a great one.
That doesn't match, Douglas.
It does. If you look at their allocations, because they're moving from equity to a debt because of the changes in their regulatory environment came in May of this year. Okay, so that one is a historical allocation from last year, by the way, is the answer to that point.
Commerzbank Tower?
Yeah, the allocated capital going into it.
Okay.
But the new capital now are looking at debt-driven instruments. So going back to an earlier point, which Richard mentioned about politics, yes, I think all the panel's answers were right, but we forget the regulatory environment of politics. We as a real estate industry failed to lobby from the German market about Solvency II. We let London drive our Solvency II ratios. We've got the same issue coming in on the pension fund sector. So the answer to your question is yes, at least from a Korean perspective, I'm seeing a conservative and a reluctance to look until they see the outcome. And we had that from a tour I did 4 weeks ago. So that's the only thing I can tell you.
But I think it's a mixed picture. I think it depends on how active they have been in Europe and how familiar they are with the individual markets. I would say some who are further away probably are just worried about Europe generally and what's going on there. But we have discussions with investors who have been on the ground for a while, who potentially also have offices here, and they very much differentiate between the different countries and allocate on that basis.
Have you spoken to the Japanese? There's that thunderous trillion on the horizon that if they start allocating money back to real estate, it's just an endless pool of cash, of course. The question is, when will their first stop be? And it would either be the UK, which is difficult at the moment, so it looks like that's another liquidity pour onto the German markets, which I think is quite frightening. But if you were just over in South Korea, did you stop off in?
For reasons of clearly, I didn't go to Japan because I came to stay in Korea, but it's the regulatory change. We can't, and Solvency II has not only for our respective institutions had a major impact in portfolio allocations and risk return. And for the international investors, in particular, I'm talking South Korean, where most of the LPs are from the insurance sector or the mutual sector, they will have major changes in their allocation. And which will mean is that the nature of how they invest, more likely go through debt fund vehicles, like provided by Allianz, would be the way they do it, because their risk return or their RBC is going to be far better. So I think one of the things is that they are setting back, but they're also looking at allocation across the real estate. Where do they get their exposure, whether it's through debt or whether it's through direct equity? And I'm going to suggest in the future we will through the direct debt recovery.
I think the changes in the last sort of 4 or 5 months also, the big impact on foreign exchange. So the whole foreign exchange play investing is really come to the fore again. Obviously, the pound depreciated. There's a case that possibly the pound is now going to appreciate quite strongly. There's probably the economy in Europe most likely to raise interest rates next. So I think that's become quite a big play on trying to analyse where your returns might come from.